Greetings. We're about to have a very important conversation. Why? Because one of the things that every entrepreneur, and when I say entrepreneur, I'm talking about somebody who is responsible for their own income, meaning that they don't go to work to get a paycheck, but they actually work as a contractor or start their own business on whatever scale, whether they're a solopreneur or somebody that scales something bigger. Something that you should know is that there are tax ramifications, and quite frankly, there's positive tax ramifications, meaning that if you take two people, one is a W-2 employee that makes $50,000 a year, and one is a self-employed person that set up an LLC or an S Corp, or we'll talk about the varying entity types, and makes $50,000 a year. The person who is self-employed is going to keep a lot more of that $50,000 because of tax advantages that they have. So every good self-employed or entrepreneur or contractor needs to have an accountant, a CPA, who understands these things and who can absolutely get the maximum tax advantage so they pay the least amount of tax and keep more money in their pocket. And that person, as far as I'm concerned, is John Briggs. So John, thanks for spending some time to talk about this.
Hey, Patrick, I'm excited to be here. I mean, like you said, people don't necessarily realize that the tax code, 76,000 plus pages, is like 99% written for the business owner and 1% of it is for the W-2 employee. Not to mention, if we consider tax reform from 2018, they took away even the few benefits that W-2 employees had, and now is even much more favorable to have a business and to be able to play by the rules that businesses are allowed to. I mean, honestly, one of the ways I look at it is I hate this idea because I think the government sucks at spending our money. So I think this is just an idea, an anecdote that helps wrap our minds around this. It's a game, and the government has created the rules for the game. And so now, you know, when you look at rules, okay, this is how I know how to win a game. Well, in this case, the tax code tells us, how do we win at keeping more of our money in our pockets? Mm-hmm. That's what the tax code was written for. People have to realize, I mean, you have companies who spend billions of dollars sending lobbyists to the government to get favorable tax treatment. And the beauty is that whether you're a small business who makes a little bit of money versus these multi-billion Fortune 100 companies, the same rules apply to both. So let them spend the money on the lobbyists and let us just take advantage of what's going on.
Yeah, and I think some people would say, but if I'm making so little money, or if it's not, you know, I'm not a billion-dollar company, I'm not even $1 million company, you know, are there advantages for me? And I think, you know, the answer is, yeah, I can speak from my own experience, but you can speak to this, is that, you know, you can write off things like if you rent a portion of your rent, if you have a home, you know, a portion of your mortgage payment every month, or if you have a car, if it's leased, or, you know, you can write off a portion of that. So why don't you maybe walk down and let me give you a little bit of context, because of course some of this stuff will matter. But what we're speaking to mostly in this series are people who either maybe had a little bit of a side hustle, maybe they drove Uber on the weekends, whatever, and now they need to expand it to something more, or people that were W-2 employees that are now saying, my job has gone away. And I'm not going back. Either I'm choosing not to go back, or they're not having me back, and therefore I have to, you know, figure out my own path to start generating income. So the question, I guess, is how should they set up as far as entity structure, and then what are some of the immediate tax things they can look at?
Yeah, I think the most important thing we have to realize here is when it comes to these rules, this game the IRS and the government created for us, is we have to at least make an attempt to be in business, right? I do have to say this as a caveat because I've experienced this earlier in my career where I had people come up to me and they're like, yeah, I joined this MLM, I'm paying $80 a month, and now I get to write off all this stuff. And I'm like, yeah, and that's awesome, but you have to make an effort at it. So these side hustles you're referring to, that's an effort. People are hustling, hence the word, right? So I just want to throw that out there. The IRS does expect you as part of their rules that you're making an attempt. Now, that doesn't mean you have to be profitable. It just means you have to be making some sort of attempt. I remember back in the day, the movie Avatar with the blue people.
Yep.
I had read a report, whether it's true or not, the outcome is true. Supposedly, they spent like 5 years just developing the technology to film that movie. Well, guess what? That's a business expense. That means for 5 years, they had zero income and a crap load of deductions. So I let people know, because sometimes they worry like, well, I don't have any income for these expenses. It's not the income, it's the effort. Now, if you are going to make an effort, one of the things to demonstrate you are making an effort is you actually set up an LLC at a minimum. So there's lots of weird terms out there when it comes to entities that people may not be familiar with. An LLC of itself is a state entity. The IRS actually, they say, we don't recognize these. They call them disregarded entities. But the fact that you set one up tells them this guy's serious about having some sort of business. And I say all that just because what you set up does determine how you have to file it. For most people, let me just say an LLC owned by yourself 100% is called a single member LLC. You're going to file that on your personal tax return. And that's where you claim these things that you're talking about, which we'll probably get into a little bit more. These expenses you likely already have, but now that you're a business owner, you're going to have the ability to claim them as deductions.
Is it okay? Like, in other words, I've heard some say that the IRS doesn't like single member LLCs. They prefer like maybe a subchapter S, entity. Is that true, or is it it depends type of a scenario?
I mean, it's more of an urban legend. Let's be honest. The IRS doesn't like anybody because we're humans. They're not. I think some of the statistics that people might be referring to and then blowing it out of proportion is this one. If you have a high W-2 and you have a LLC that files on your personal return that shows a very large loss, that is a trigger that increases your chance of being audited. Doesn't mean they dislike you. It also doesn't mean you can't prove that you were in business trying to make money and that all those deductions you get to keep. It just means you have a higher chance of being audited. That's all that means.
Okay. So some might say, okay, is it expensive, to get this set up? What's the investment to set up an LLC?
That does depend on the route you decide to go. There are two categories of people who can set up businesses: the owner themselves or a licensed attorney. So if you're going to go the licensed attorney route, obviously they don't work for free. They're probably going to charge you something, but I mean, a lot of them are pretty reasonable. So you might pay $500 to $1,000 to get an entity set up. Or you have the owner set them up themselves. Depending on the state you're in, sometimes it's easier to set up than others. Like we're in Utah. Utah is actually pretty easy. You just go to their website. I mean, for someone who's never done it before, you click the register new business. It might take them 30 to 45 minutes to set it up themselves. And that's free. And then they charge you like $85. Some states have different fees. California, New York, obviously are more expensive. But from an expense standpoint, when we're talking about taxes here, which is kind of our largest expense that all of us will have in our lifetime, I should say. I think it's worth it. It's kind of like an investment. You might pay up front now, and again, a few $100 to save thousands year after year after year. Yeah, so I don't look at it as expensive at all.
And I think the in-between would be like LegalZoom. You're not hiring an attorney. You're not trying to do it on your own. They kind of walk you through, which, and it probably is in the in-between, like a few $100s or something like that to set something like this up on LegalZoom. So those are probably different pathways. Does it make sense? Let's talk about, we'll start kind of a gig economy to maybe talk about like an Uber driver. So if somebody's driving Uber and they're making over $30,000 a year or more, maybe even less. You could speak to that. Does it make sense for them to also do this? Because would they consider saying, "Hey, I'm in my own business. I provide this service. I get paid money," and they could. I mean, I think they already can write off their gas and probably wear and tear, even if they're not incorporated. But does it make sense for somebody in that realm of the game to incorporate?
Yeah, that's a great question. Let me backtrack for a second, though, on just some basic entity structuring. As you mentioned, an Uber driver, whether they incorporate or not, will be able to claim these deductions. Mm-hmm. So the incorporation isn't necessarily the thing, but I just want people to understand, you have the term called sole proprietor. That basically means you have a business based on tax rules and you can claim a deduction. Or like you said, it means you're not incorporating yourself. That's a sole proprietor. Then you can incorporate yourself. And then from there, you could set up an LLC. Depending on your income, we recommend if your net income, so after expenses, if you have $5,000 or more in the year, then you should consider looking at getting an S corporation instead of just an LLC. And when I say that, I also want to explain LLCs are state classifications, S corps are tax classifications. So of course that can cause some confusions. You can have an LLC and then tell the IRS, I want to tax this like an S corporation. And that's what most people do. And that's the route in most states we recommend. But again, we're not attorneys. Based on your state laws, you should check with your attorney to see if that's the smartest route for your state. But let's assume then that this Uber driver, and we can talk about both scenarios. Let's say there's an Uber driver who makes less than $5,000 of net income, taxable income during the year. Even maybe they show a loss. For sure, the gas they put in the car, they have two options. They can do the gas, wear and tear, repairs, interest on the loan if they have that. You can claim the actual expenses, or you can just claim your business miles. For an Uber driver, the fact that their business to generate income is their mileage, basically, they're probably going to get a much better deduction out of claiming mileage. Plus, it's way simpler. But that's regardless of the amount of their income, they should be writing off all of their miles without a doubt. And that's not just driving to get your fare and taking your fare. I mean, that's driving to the location where you're going to then turn on your monitor saying you're ready to drive. It's driving, it's miles driven when you're going to spend money on your business. I mean, so for most people, especially married people, almost 100% of your miles should be considered as a tax deduction.
Thanks so much for being here and watching that video. And can I ask you to please subscribe to our channel so you can find out when we're posting new content. You'll be alerted right away when we do. To share this with people you think might benefit from the information, and certainly it helps us if you like the video. So if you like what you just saw, go ahead and hit that like button. And again, thank you so much for being here with me right now.